Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 3rd of April. I'm Daniel Lam, your host for the podcast. The long-awaited Liberation Day tariff announcement was larger and broader based than expected. Starting from the 5th of April, there will be a minimum of 10% tariff on all goods imports coming into the US. But the effective tariff rate against a broad set of US trading partners will rise sharply on the 9th of April. That is the news which is hitting risky assets the most right after the announcement. So compared to estimates, there will be higher reciprocal tariff being levied based on the administration estimate of both tariff and non-tariff barriers those markets impose on US goods. So the highest tariff rate will be imposed on China and the other Asian economies. So for example, the effective tariff rate on China would become 54%, Vietnam at 46%, and Japan at 24%. In the meantime, the 20% tariff imposed on the EU today would be the most significant incremental shock to the global outlook. The key focus will be the impact on inflation and growth. There are estimates that, if implemented, the effective US tariff rate would likely approach at 25%. Putting it on a base of $3.3 trillion of goods imports into the US, the cumulative tariff hike should be equivalent to just over 2% of the US GDP and may add 2% to the US CPI this year. Now, Treasury Secretary Bessent described the announced tariff as a ceiling, assuming no retaliation, and suggests room for negotiations. Well, but as you can hear, there are simply too many ifs in that statement. What has happened is resulting in heightened volatility in the markets over the near term, with pressure on business and consumer confidence. So therefore, it is no surprise to see gold going higher after this announcement, making highs with increasing strength, according to its RSI. Investors can be adding incrementally at the current levels and more at key support, such as 3,000 and 2,900. Gold remains our key overweight amongst our asset classes. Equities reacted sharply down, with S&P 500 futures down 2% and Nasdaq futures down 4%, while Nikkei is also currently down 3%. We believe equities is likely to be volatile in the near term, with news of retaliation and negotiation leading to sharp whipsaw movements. The high tariff announcement on China is likely to lead to a healthy correction in Chinese equities, which we're overweight. It is possible that the Hang Seng Index would reach the 21,600 key support level that we've been highlighting previously in our podcast. That would be an interesting level to add to our opportunistic idea in the Hang Seng Technology Index, with DeepSeek ultimately be a strong fundamental supporting factor, and also likely government stimulus to counteract the tariff effect. Lastly, US 10-year Treasury yield went very close to the 4% level, which is the lower bound of our 12-month estimate at 4% to 4.25%. The lower yields also lead to a weaker US dollar, but it was relatively muted in its movement in light of such a major announcement. We believe the upcoming retaliation and negotiation will be leading to some volatile moves in individual currency pairs. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.